Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one. And that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel?
1, you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, But then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games. They're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You got to make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Wti, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Wti and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
里面有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to, show in some ways that they're authentic, right? So for Wti and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows, and we see like P&G have their own sales room which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming in to our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
solar and wind energy were fully commercialized, there were a lot of amazing technologies implemented everywhere, I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
from? Where are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act like this. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in this for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to a jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Pasi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
Yeah, it's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
Discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this isn't a car company. This is not the KGB.
I think it's fair to say that Rob Posse didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Hari Nada is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera
It's a
to
very
me.
sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness. From my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. It seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. Amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but there's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is Wti Futures Contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is, is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network. That in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
From New York on TV and radio, good afternoon, good afternoon. Counting you down to another Fed rate decision and Chairman Powell news conference alongside Tom Keene and Lisa Bramford. I'm Jonathan Ferro. TK, it is different this time. We're looking for some action.
It is so different. I just looked at my watch, John. I believe it is 8:30 in Kyiv and across so much of Ukraine, and it's real simple. Chairman Powell can't lose sight of it's nighttime in Ukraine, and there could be more bombing, more violence. That colors every bit of economics this afternoon.
And no doubt, Tom, it will color the forecast from this Fed as well. A drop to the growth forecast, a lift to the inflation forecast, and something has got to happen with the dot plot too.
Can the three of us agree right now that this is it about the inflation uptick or the growth markdown? I don't know which.
It's got to be about the news conference, Lisa. Where is the emphasis, or does he choose to de-emphasize parts of this forecast given the lack of visibility we have worldwide?
There seem to be three main issues people are looking for in that press conference. How much does he signify that a 50 basis point rate hike is still on the table later this year? How much does he talk about quantitative tightening perhaps in May or June? And what is that terminal rate that they seem to be targeting by those dots? How much consensus is there, John?
Do they choose to signal a restrictive path, a restrictive policy at some point in the future?
And then if they do, what's the goal of that? To further slow growth, especially at a time where growth is already expected to slow?
We've got some big moves in this market, in the equity market, on stocks right now, on the S&P 500, up a little more than 1%, on the NASDAQ 100, earlier this week, in a bear market on the NASDAQ 100, on the NASDAQ Dow, up by more than 2%. And Tom, can we sit on this bond market? What a move we've had over the last couple of weeks. 217, let's call it 218 on a US 10-year.
Yeah, you've seen the yield move, and the curve steepening is there. Somebody said to me today, we have a flat yield curve. No, we had a flat yield curve 10, 12 days ago. We've gone from the worry of zero, maybe down at 19, whatever, we're up a 10-cent solid, even 20 basis points to 30 basis points. For those of you that don't know that math, all you need to know is Chairman Powell's a little calmer than he would have been 2 weeks ago.
The swing in this commodity market, Lisa, pushing 130 at one point just a couple of weekends ago. Right now, 95.45.
How do you get a sense of what oil prices are going to do and what that input into inflation really is going to be if you've got this kind of volatility? We're going to discuss all of this coming up with an amazing slew of guests. Coming up, we've got Matt Lazzetti of Deutsche Bank, TD Securities' Priya Misra, as well as JP Morgan's Michael Feroli. We'll be doing a drumbeat to that 2 p.m. Eastern Fed rate decision, talking about the prospect of quantitative tightening, as well as that terminal rate. Immediate reaction after that from Guggenheim's Scott Meinard and Grant Thornton's Diane Swank. They will be talking about the economic trajectory and how far those rates can go. And finally, breaking down the chairman's news conference with some post-Powell commentary from Dartmouth's Danny Blanchflower. I wonder if he thinks they should hike rates. And Deutsche Bank's Alan Ruskin. I always love getting his sense, given the fact that you need a variety of senses of what should potentially happen at a time of, frankly, such deep uncertainty, John.
I think it's fair to say the one thing we can predict and forecast today is Danny's reaction to the rate hike we'll most likely get from this Federal Reserve later in the next 60 minutes. Mike McKee joins us now. Mike, how tough is this meeting for Chairman Powell?
Well, I thought you were going to ask how tough it was for Danny Blanchflower. I think he'll be happy. It is tough for Chairman Powell because we know what he's going to do, but the question is in the markets, what's next? And that'll depend in large part on the way the Fed chairman structures his comments in the news conference. Now, 25 basis points is pretty much baked in. They'll also raise the rate on interest on reserves and reverse repos, and they'll change the statement significantly. But then it becomes a question of how fast and how far do they go with rates, and for that, they will be adjusting the dot plot and they will be adjusting their economic projections. Now, some of those projections were absurdly low, as somebody said today, back in December, especially for inflation. They're going to have to come up a lot. And then we'll take a look at the dot plot and, as Lisa mentioned, the terminal rate, where they go in the end of their moving cycle. You look at the dot plot and you can see that basically the market was behind the Fed back in December, but now is way, way ahead of the Fed in terms of rate moves. And we're going to be looking to see how fast the Fed thinks it's going to move rates this year and next. And then all the way out on the right-hand side, the terminal rate, how high they think they'll go eventually. And this will all fall back on Jay Powell's shoulders because, of course, the Fed's whole monetary policy the last couple of years has been to try to bring down the unemployment rate. Well, when you are raising rates, you are raising the unemployment rate. And you can take a look here. The Fed has only once in the last 40 years been able to raise interest rates without raising unemployment. That's the yellow arrow there. That was 1994. And it is a problem for a Fed that wants people to stay at work. How firm will Jay Powell be in saying he's willing to put up with higher unemployment, perhaps even a recession? The Paul Volcker answer, as he was asked the other day.
And Michael McKee, thank you so much. And really underscored in a blistering essay this morning by Lawrence Summers in the Washington Post. With the leadership of Folkers, Landau, and Hooper, Deutsche Bank has been out front with some amazing nuance linking the broader macroeconomy, the big picture Powell, with the nitty-gritty of America. Matthew Lazzetti starts a strong, chief U.S. economist, Deutsche Bank this morning. I love, Matt, the line, motivated by rents. How did rents that our listeners and viewers are paying, the home prices, et cetera, how is that affecting Jay Powell?
Sure. First, thanks so much for having me. I think what we've really seen in the inflation data is an evolution from something that was very narrowly focused. It was focused on goods, on the supply-constrained items, over time to something that is far more broader-based. It is concentrated now in services. It is significantly being driven by rents. And the inflation data that we've seen, certainly since that January FOMC meeting, the last two trim mean CPI prints, trim mean CPI on a 12-month basis is the highest that we've seen on record since 1982. And so this latest inflation data, along with what we're seeing in wages, is absolutely telling the Fed that this is a far more persistent inflation shock, one that they need to respond to, ultimately one that I think they will have to get to a restrictive stance, but we'll see how far they go in that direction today.
Matt, do you think that they're going to discuss whether a restrictive stance could come sooner simply because there is already a restriction in this stagflationary impulse from the commodity shock we've just been going through?
Yeah, I think that this is another supply side shock that we're dealing with at the moment. It is one that is going to lift inflation again, and it's one that is going to dent growth again, and no doubt we'll see that in their own forecast this year. I think the real risk is with the inflation and kind of the energy and gas price moves that we've seen, is that it does begin to filter into longer term inflation expectations. We tend to see that particularly for the consumer. And so when you look at this inflation picture with wages rising as they have been, with the breadth of the price gains that we've seen, and ultimately if inflation expectations do begin to rise, I think that really kind of undermines the last data point that we could have about this being a temporary transitory story, and really will tell the Fed that they need to move a lot more aggressively. They need to get into a restrictive stance much sooner than they currently anticipate.
Matt, let's wrap things up. What you predict for this year, for 2022, stack that up against what we'll actually get today, including balance sheet reduction, because you guys at Deutsche Bank have thrown out some big numbers.
Yeah, so we think that you'll get 6 hikes from the median dot today. We are at 7 rate increases. I think there's a very real risk that they move by 50 basis points at the upcoming meetings. We were expecting 50 basis points at this meeting before certainly the events that have happened in Ukraine. So I think we'll get some messaging that suggests that the market is correct in pricing that risk premium over the next several meetings. Beyond that, we think you get the balance sheet unwind. We expect about $800 billion of unwind this year, more than $1 trillion of unwind next year. That's $1.9 trillion together, which we think is an equivalent of 3 or 4 rate increases. That, I think, is a big unknown. We've gotten a lot less guidance from the Fed on that, so we'll see how much we get there. But I think we'll get the continuation of this hawkish messaging from the Fed, but a continuation that I think will continue to move in a hawkish direction. We need to see more than 6 rate increases, and we think that you're going to need to see very material balance sheet reduction.
Matt Lazzetti of Deutsche Bank at the Deutsche Bank Center with some massive numbers. Matt, thank you.
The Deutsche Bank Center?
The Deutsche Bank's no longer the Time Warner Center, Tom. It's Deutsche Bank now.
I didn't know that.
We're just, trying to support their effort.
Haven't we done this before on this show?
We've done that a couple of times,
I
Lisa.
get over there once a year. It's on 59th Street.
Ramo,
so
people
it's,
still calling it the Time Warner Center. Anyway, we'll park that awkward part of the conversation. Lisa, these are some big numbers. Balance sheet reduction pushing $2 trillion. It might not even get started until the summer.
Yeah, and Priya Misra, who's coming up of TD Securities, thinks that we are not pricing in balance sheet reduction and that it could start as soon as May. I just wonder what they're trying to go for, given all of the discussions beforehand, John, that this is an untried strategy. They have a sense of what rate hikes do, not so much when it comes to the balance sheet reduction.
They're going for credibility. Their deepest fear, and Professor Summers gave them some slack today on this, is the pressure to maintain credibility. That is the #1 thing.
Or reclaim it. Tom? Because some people think they've lost it. And if you want to reclaim credibility, do you have to signal the willingness to take this to a restrictive stance?
Yeah, I
Does that have to be implied by the forecast today?
And that's somewhat of the indicative of where the terminal rate is. As Mike McKee said, where's the terminal rate?
Tom Keene, Elisa Bramis and Jonathan Ferro counting you down to that Fed decision about 18 minutes away. Up shortly, Priya Misra of TD and Michael Ferroli of JP Morgan with your equity market up 1% on the S&P, on the NASDAQ up 2. This is Bloomberg.
Bioworks was founded in 2009 by several big brains from MIT. The founders wanted to develop ways to treat DNA more or less like software code. You find an organism with an interesting property, snip out the DNA behind that property, and then shove the DNA fragment into something else. The big promise behind synthetic biology is that we'll find a new means to harness nature and bend it to our will. We'll be able to manufacture things like chemicals and fuels and even physical objects in ultra-efficient ways.
Biology is ridiculously advanced, and we're just entering the era of being able to program it to do new things, and it's programmable because inside of it is digital code that we can, as humans, read and write.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
What's important to watch today?
I want to see if they're opening the door to 50 basis point hikes.
What is that terminal rate that the Fed is projecting?
I'm also looking at the quantitative tightening. How fast will they roll that forward?
What happens to the yield curve?
For the bond market, you know, the key is, well, where are we going from here?
How that yield curve trades in 2s, 10s is going to be very important.
I want to see that trade-off between growth and inflation.
Obviously, this Russian invasion of Ukraine only exacerbates the growth slowdown.
The Fed's hands are tied here. It's a really tricky position that they're in. They do have to hike in order to tackle inflation.
The overriding thing that the Fed is going to focus on, I think, is going to be inflation.
The Fed's going to have to be aggressive to reestablish credibility here.
Your Fed decision is about 15 minutes away. We are looking for the first interest rate hike since 2018. Here's the price action coming into that on the S&P 500. We're positive by more than 1%. On the NASDAQ right now, up by about 1.9. On the Russell, up by 2. Where we were the last time they met, pretty much flat, about 40 points higher than this. In the bond market, though, massive changes. The 2-year has gone from 115 to this, 187.62. The 10-year has gone from 186 to this, 219. Tom, I've mentioned this a few times already through the day, that the 2-year is now where the 10-year was the last time this Federal Reserve met at the close that day. That is a big change. The other thing that's changed, the shape of the yield curve. 2s and 10s has gone from about 70 basis points to 30 in the last few months, Tom. That is a flatter curve in the face of a Fed that hasn't even started hiking yet.
And of course, the inflation-adjusted yield, the real yield, folks, has really gone in a Powell-friendly way from a negative 1.00 just in days, negative 0.65 is constructive. I'm blown away by the conversations we're going to have today, starting with Matt Lozzetti. We move on, Matt Ferroli, to join in a moment. Every single guest we have today is of exceptional value. Priya Misra is global head of rate strategy at TD Securities because she had the courage out front to end up where the street is. The street's looking for 6, 7, 8, 12 rate increases, and she said all along, wait a minute, slow down, and let's watch the news and the data go by. Priya, you have a huge sentence in your report. Forward guidance is dead. Do we look at the death of the dot plot today?
Well, the market's going to pay attention to the dot plot nevertheless. I think forward guidance is dead because inflation is inherently always uncertain. It's very high. The Fed has a long way to go to get inflation lower. I don't think rate hikes actually right now do much for inflation. And so the Fed's going to keep all options on the table. But the bond market, the broader market, we're all going to look at the dot plot. And I think what I'll be watching will be that endpoint. That terminal rate is the majority of the committee or even the hawks, are they talking about going restrictive? Is the right policy to go well above 2.5, which is not priced in? Because I'm looking at the market's priced for today. What's not priced in? We're not pricing in restrictive policy. So the dot plot where it could be useful is, does the Fed think that in order to get inflation back to target, they'll need to go well above 2.5, which means an inverted yield curve, which means rate cuts, which actually means a recession further down the road. So that will be useful, I think, in the dot plot. If I was at the Fed, now is not the time to talk about restrictive. We're starting the hiking cycle. They've got time to take that call later in the year if inflation doesn't decelerate as they expect. But, we don't know. So that's what we'll be watching on the dot plot. So that's still going to be important.
Priya, the other thing that you don't think is priced in is just what the effects will be of quantitative tightening, which you think could come as soon as May. Can you give us a sense of how it's not priced in?
Sure. So, I won't say it's not at all priced in. The market knows that QT through balance sheet runoff is going to happen at some point this year. I don't think we know how to price it for the simple reason that we don't know the implementation details. What are the caps? Last time they had 30 billion for treasuries, 20 billion for mortgages. What's that number now? We have no sense of caps. Our sense is 60 billion for treasuries a month, 30 billion for mortgages. But once we know that, I think the market can price it in. So we don't know the details. We've gone through QT only once before, and really only the US has gone through QT. So we don't even have other countries we can look at. We have one episode. And then I would argue that the effects are nonlinear. The market always struggles to price in nonlinear effects. The first trillion might be okay, and then the next trillion. And we're talking about balance sheet runoff. Remember, they're not being nimble on balance sheet runoff. So once they start, it's going to happen in the background. And the tightening in financial conditions, the move higher in real rates, I think that's going to just build over time. It's always hard for the market to price that in. But I think if we start to hear details, the Fed talks about when it's starting, how they are planning to do it. Are they going to sell mortgages? The big questions are out there. Once we know this, the market starts to price it in. And I would look at real rates. Financial conditions need to tighten. The different ways that QT will get to be priced in. And I think actually QT is far more impactful for financial conditions as well as the economy compared to rate hikes, because we're already pricing in a lot in terms of rate hikes.
Priya, can I ask you a question that Deutsche Bank asked in the last couple of days? What would the stance of monetary policy be today if the Fed was still operating under the prior framework and not this one?
You mean without fate? I guess I would have argued they would have started hiking earlier. They probably would have ended QE much sooner. And so it's a key question you're raising. What's the Fed tolerance for high inflation? I would argue under fate, they should have a higher tolerance. Can they achieve a soft landing this time around? Because they might be okay with inflation PCE at 3% at year end. As long as it's decelerating. It should be lower than today, but if it's decelerating, does fate allow them to run a higher tolerance for inflation, which they could not do under the previous policy?
Well, close to 8%.
So does it allow a soft landing?
I think they've made that move, haven't they? Mike Feroli's with us too, Chief US Economist at JP Morgan. Mike, looking ahead to this decision, the forecast too, what are you looking for?
So it sounds like consensus are looking for their dots to show 6 hikes this year, maybe 3 and 2 in the subsequent 2 years, which would put policy by the dot plot into restrictive territory. But I think away from the dots, what I'm kind of focused on is a statement. The statement language in January, it didn't use the word transitory, but it described inflation as related to supply and demand imbalances related to the pandemic and the reopening of the economy. Well, those are kind of transitory elements that are driving inflation. So I'm looking to see whether they actually kind of move away from that still like sort of quasi-team transitory to actually recognizing that the inflation issue we have is more cyclical and hence a little more entrenched, which would require, more work for the Fed to do, not only this year, but perhaps next year as well.
Michael, let's dust off the textbooks. You're the only one who's ever come out of Booth School who read every single word of John Maynard Keynes. We know that quite well. And one of the phrases from back then we're reliving now, which is money illusion, which is how central bankers behave given high inflation. 98.2% of our audience has never experienced that. What's the money illusion Jay Powell has to pay attention to in the coming year or two?
I think perhaps one element of the money illusion is focusing on nominal interest rates. So if inflation expectations are moving higher, then the level of nominal interest rates that will lead to higher real interest rates subsequently has to be higher. So I think that is one reason why they're pretty focused on inflation expectations. If they drift higher, not only is that a problem, but that means they're chasing a higher nominal rate that would lead to restrictive real interest rates. So I think that's one aspect of money illusion that hopefully Powell doesn't lose sight of in the coming quarters.
Michael, one area that I think you may disagree with Priya Misra of TD Securities on is just whether the Fed will signal a restrictive stance at some point in the future. You indicated that they probably would signal 6 rate hikes this year, 3 the following year, 2 in 2024, which would take that end rate to a restrictive level. Why do you think they're going to make that?
Well, I think the economic conditions call for restrictive policy. Right now, the unemployment rate is looking like it's going to be below the natural rate for the entire forecast horizon. Inflation has already beaten all of their fate goals, and so there is a reason that they should cool the economy off. So I think the economic case for restrictive policy is evident in any simple policy rule you want to look at, and just basic common sense about how monetary policy affects aggregate demand and hence inflation over time.
Hey, Mike, I know you've got to run before the decision, 5 minutes away. We appreciate your time. Michael Ferrari there of JP Morgan. Priya, looking at this move in the bond market, 2's approaching 190, up 4 basis points this morning. How much more can we build in to the front end of this yield curve?
I think we've priced in a lot, and really it's going to come down to if the Fed suggests, going restrictive in the near term. I mean, the one pushback I would make against the restrictive point is they've got QT. In the last few cycles, they never had QT, which was tightening financial conditions. They're going to use both tools to try and slow things down, and QT does work. And we're talking about $2 trillion, $1 trillion a year of bonds running off. That's not going to impact the 2-year. That's like a 5-year, 10-year. So I actually think the front end's very well priced. If we get signs of QT, look for that 5-year, 10-year real rates. Look for all of that to start to move higher, which is going to then slow the economy down and tighten financial conditions.
Priya, they talk about it like it's like paint drying. They did that last time around. It was anything but. This time, are you saying it's a more active tool? They talk about it as if it's a passive one.
It's still a passive tool, but it's a really large tool. I mean, the balance sheet is almost $9 trillion when we're talking about $1 trillion running off a year. So these are large numbers, a lot of supply that the market will have to take down mortgages and treasuries, a lot of reserve drain that the banking system would have to live through. I think it's not an active tool, I agree with you, but it's a big tool that once they set in motion will continue until they are actually cutting rates. So it does tighten policy. It also interacts with rate hikes because they're going to be raising rates along with the balance sheet running in the background. And it's a hard one to calibrate. The Fed has been pretty upfront that they don't know how it works. There's not a clear equivalence, I would argue, with rate hikes. So I don't think they can be nimble on balance sheets, so it'll show up on the rate side then.
If we agree that the impact of these actions, Priya, is nonlinear, that there's an accelerative treatment to neutrality and to restriction, I'm trying to work on my vacation calendar. May 4, June 15, July 27, September 21. Which meeting matters to Priya Misra?
under this new Fed lack of forward guidance, every meeting matters. But it's also what the market's pricing in. So we think they're going to hike in May, and they're going to announce QT. But as long as we know the details, the market will price it in. So it'll start June 1. But if we know how much is running off every month, I think the market prices that well. But I would say that Chair Powell is going to keep that 50 basis point option alive in every meeting.
Wow.
Until inflation declines, which may not happen this year, that 50 is going to stress you out every meeting, and the market's going to be focused every meeting.
In other words, Tom, you can't go on vacation.
He's already
any
done it.
Fed day.
He's already planned
going
it.
forward. That's
It's in the
actually,
diary, Lisa.
I mean,
He's done it already.
So he's basically trying to figure out how guilty to feel about it. Is that what's going on here?
Of course it is. And I actually answer the question too. I think the middle of this year, this Fed's still hoping inflation fades.
Yeah.
And to Priya's point, we had a conversation earlier in the year about maybe front-loading action. I wonder, Lisa, if the risk is they have to backload it.
Honestly, this is a big question, especially as you see some of these inflationary inputs right now that are not rolling over in the same kind of way. Priya, to the restrictive point, is the economy strong enough, given the labor market and given some of the momentum in retail sales, albeit a bit of a hiccup in today's numbers, to overcome any tightening, to overcome the restriction that sort of is inherent in the Fed's function?
I think, the first few rate hikes until 2.5%, I would still look at real rates, and real rates are still low. Long end real rates are well into negative territory. We also have savings for the consumer. There's wages are growing. I think the economy can handle it for now. Where I do worry is you get closer to year end, and if the Fed is talking about taking rates up to 3% or higher, along with balance sheet running off, so the 10-year Treasury is moving higher, there's your mortgage rates, that's when it starts to get tricky, because, it's sort of all the tightening in financial conditions starts to weigh on the consumer. But for now, I think the economy does have enough strength, and that'll give the Fed comfort that they can try and at least achieve a soft landing.
Hey, Priya, great to catch up with you. Priya Misra there of TD. Looking ahead to this Fed decision a couple of minutes away. Just remember these forecasts. The previous forecast, Tom, for 22. 4% on GDP, 2.7% on PCE, and on unemployment, 3.5%. How much will those first two change when we get that update to the forecast in just a minute or so?
I make a joke about it, John, but you're absolutely serious. You're absolutely correct. That this is serious stuff. And these are good people, smart people. And Larry Summers, in his criticisms today, I thought gave him some great respect. This is tough duty now to guesstimate this forward.
They're in a tough spot, Lisa. And in the last couple of weeks, they got a second shock.
Honestly, this is really the question to me. Is there enough momentum, given the rollover that might come from this shock, to withstand additional shocks from Fed tightening and from a potentially restrictive policy? And that, I think, is what a lot of people are struggling with and wondering, why are we in this situation at all?
TK?
I'm wondering what Jerome Powell's bracket looks like. I mean, he's filling it out,
That's where your attention is 30 seconds away from the decision. I think that news conference for this chairman is going to be really, really difficult.
Yeah, it is.
One of the hardest that he's had to do over the last few years. The reason for that is because last time around in the pandemic, it was easy. Cut rates, do QE. This time around, what do you do when the risk to growth is to the downside and the risk to inflation over the last 6 months has been to the upside? Your equity market on the S&P 500, up a little more than 1%. On the NASDAQ, up a little more than 2%. If you get to the bond market, the stage set as follows. 10 seconds out from a Fed rate decision. Yields on 10s at 218.49, on 2s at 188. From New York City with your Fed decision, here's Mike McKee.
The Fed has raised interest rates as expected, raising the Fed funds target range to 25 basis points to 50 basis points, a 25 basis point move. They are raising the interest on reserves to 0.4 percentage point and the reverse repo rate to 0.5 percentage point. That stays the same. The dot plot promises much more ahead, as many as 6 rate increases this year, taking the overnight bank lending rate to a 1.9% level by the end of 2022. By the end of 2023, we go to 2.8% before dropping back in 2024 and beyond to a neutral rate of 2.4%, which is lower than the Fed had been projecting in the past. The Fed, in its comments, saying, with appropriate firming in the stance of monetary policy, the committee expects inflation to return to the 2% objective and the labor market to remains strong. In support of these goals, the committee decided to raise the target range for the federal funds rate to 1/4 to 1/2% and anticipates that ongoing increases in the target range will be appropriate. They go on to say, in addition, the committee expects to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities at a coming meeting. Now, that's the only reference to the balance sheet, no details on what their plans are or when they're going to tell us about them. They do mention the invasion of Ukraine by Russia, saying that is causing tremendous human and economic hardship. The implications for the U.S. economy are highly uncertain, but in the near term, the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. Speaking of economic activity, they're expecting the United States economy to grow at a much slower pace than they were back in December when they thought we would see 4% growth this year. Now that's been marked down to 2.8%, 2.2% in 2023, and 2024, 2%. Those are basically the same numbers we saw in December. Unemployment, 3.5% this year, next year, and 3.6% in 2024. So they don't seem to be thinking their rate increases going to raise unemployment. Inflation, PCE inflation was 2.6% for 2022 in the December forecast. It's now 4.3%, dropping to 2.7% next year and 2.3% in 2024. And as we mentioned, the long run rate for the Fed funds is going to be 2.4%. So 2.4 would be neutral for them. There is one dissent today, guys, and that is St. Louis Fed President Jim Bullard. He thinks the Fed should have gone 50 basis points. It's a 9-1 vote.
You working through that, Tom, still?
I look at this Mike McKee, and we're looking, folks, at 40 and 50 headlines that Mike McKee goes through with great preparation. And, Mike, I am absolutely thunderstruck that they wander back to 5% nominal GDP 2 years out. How do they propose that occurs? Inflation disappears?
That would seem to be the argument that the survey of economic projections, the summary of economic projections makes, because at this point they're seeing growth at about where it was before the invasion and before the oil prices started to shoot up, whereas inflation is going to go up significantly and then drop by more than 2 percentage points by 2024.
Going to go through this price action, Mike. We fade on the equity market on the S&P, up 8 or 9/10%, on the NASDAQ, up by 1.7. Looking at the bond market, yields up at the front end on twos. Can we get to that and just look at treasuries? What a move, up 9 basis points to 193.79, pushing 220 now on 10s, up by 4 or 5 basis points. This was never about the 25 basis point pop. It wasn't even about the descent from Jim Bullard looking for 50. It is all about that dot plot. Mike, to see 22 go to about 1.9%, then 2.8% for 23. Think about where this dot plot was just 2-3 months ago.
And you have 5 members of the Open Market Committee saying we could be over 3% in 2023. So there is some disagreement over how far they're going to have to go to bring the inflation genie back to the bottle, let alone stuff it back inside.
This is a big change, Bramo, a big change for this Fed, finally catching up. I have to say, out of all the hawks out there on Wall Street who were looking for 6-7 hikes through 22, they were laughed at. I think even some of those didn't expect to see that actually materialize in the dot plot this time around.
2.8% by the end of next year. Is that putting that in restrictive territory by the end of next year at a time when people are already talking about slowing growth? And I do wonder, Mike, whether that seems to be the implication here. And frankly, in markets, you're seeing those yield curves flatten with the gap between 5-year and 30-year Treasury yields going to the narrowest since 2018.
Well, they're telling you that they're going to have to be restrictive at this point, which is a fairly hawkish statement for them to make with all the uncertainty still out there. Because the neutral rate, they're saying, is 2.4%, so they're going more than a 1/4 percentage point above that, and that would really put the brakes on the economy if you think that 2.4% is a legitimate neutral rate. And you have people like Larry Summers saying it might have to be 5%.
John, I just did the 2-year yield you've been highlighting, and I did it with a log y-axis, which shows rate of change, and the rate of change now is extraordinary. John, it is stunning how the 2-year yield is back to late 2018-ish when you look at the rate of change. It's
on January
absolutely
26th, Tom, this 2-year yield closed at 1.15. That was when the Fed last met. We're now pushing 2% on a 2-year yield.
I mean, I was doing the math there, folks, with this pause, and that's what we do. And we do that with great conversation with great guests. Scott Miner joins us right now, Guggenheim Global Chief Investment, and he has built a career on the first derivative. Does the Fed have control, Scott Miner, of the rate of change, the first derivative of these market movements?
Tom, I think it's pretty clear they don't. And, it's really amazing when you consider that how much how the market has changed and repriced over the last 3 months. And Fed guidance. So, I'm a great believer, Tom, that the market should be allowed to do what it does, and the Fed should just focus on its responsibility, which is price stability, and that is done through the money supply and controlling the balance sheet, and they should just let the market, including the overnight rate, just unpeg it and let it go.
But, Scott, that's not going to happen. That theory, I'm not going to say it was debunked, but it is certainly not on the principal theory of this Fed right now. Do you discern a theory of this Fed other than to react to what markets hand them?
Not at all. I mean, I would put the Fed at a level of panic. That is that, every piece of news that comes out, we have this sort of rethinking the erratic nature of the dot plot, the discussions about shrinking the balance sheet while we're going to raise rates, and we don't even know what the impact of raising rates is yet. So I think they are in an inflation panic, and they've gone from transitory to, we have to be much more aggressive than we were saying a few weeks ago.
Let's move in a bond market. Scott, what a move. Up 11 basis points on 2s, pushing 2% on 10s, up to about 220 on 5s, almost at 222. So look at the difference between 5s and 10s. Let me tell you, there's not much of a difference whatsoever. It's 1 basis point right now, Scott. Typically, this Fed would say, don't look at the dot plot. We'll de-emphasize that. Do you think he embraces this in 22 minutes' time?
Yes, I think he actually will embrace the dot plot, Jonathan, and that's because I think that the Federal Reserve believes they actually have more control over what's happening than they do. And if you just took the yield curve, for instance, we know that the curve flattens as we reach the end of a tightening cycle. And when you look forward, 2 years and how flat the curve is, or 5 years and how flat the curve is, the market's telling you the terminal rate for the overnight funds rate is somewhere between 2 and 2.25%, despite anything that may come out of the Fed, including the dot plot.
Senator Richard Shelby, in a hearing a number of weeks ago, Scott, said, are you prepared to do what it takes to get inflation under control? Chairman Powell answered, I hope history will record the answer to your question is yes. Now, a lot of people are wondering who we get at 2:30 Eastern in that news conference. Do we get a Chair Volcker? Do we get someone else? Who are you looking for in 20 minutes?
In terms of, Jonathan, who's...
The kind of chairman, do we take this back several decades when we had to do something to break the back of inflation? Where are we going with this?
Yeah, I think we're going to get something that is hawkish, but it's going to look more like Greenspan than Volcker. Volcker will say, I will do anything we have to do. Greenspan will try to balance the risks between financial markets, the economy, and inflation, and be a maestro. And I think he will attempt to be a maestro.
All right, so how do you be a maestro? How do you have a Fed put at a time when, frankly, exactly the turmoil that you're seeing in markets is part of the only tool that the Fed has to dampen inflation?
Right. Well, Lisa, look, inflation is always and everywhere a monetary phenomenon. That's the words of Milton Friedman. And what we need to do is control the money supply, control the balance sheet. And, as we've been talking today, with that is not the mindset of the Fed. The Fed thinks it can control interest rates. And so somehow it's going to manage its way through. So, I think that the Fed has largely abandoned monetary orthodoxy. It's trying to be too cute in how it's managing this. And ultimately, if we just would stop growing the money supply, just as we experienced in the 1940s, inflation dropped from 20% to deflation within 2 years by just not expanding the balance sheet. The Fed would be able to bring a market soft landing into place. But I think right now, by trying to adjust short-term rates and talking about adjusting the balance sheet, the Fed is likely to create an accident of some kind, just like we did in the second half of 2018 when they attempted the exact same thing.
An accident of perhaps a different caliber in terms of what's at stake here. What do you think the biggest consequence will be? What do you think the biggest historical judgment will be when we look back on this period of Federal Reserve banking?
I think that they will look at a period of a series of folly in terms of Fed activity. That is that they probably overreacted to the pandemic. They pumped too much liquidity in the system, and then when faced with a surge in inflation, that they hit the panic button and that they tried to reverse course too quickly and ultimately create some sort of a financial accident.
Scott Miner, thank you so much. John, we got to reset here with the move. John, I'm going to talk about the 2-10 spread. It is absolutely crushed. The focus is on short-term yields, John. I think it speaks volumes that 2-10 spread is gapping down near 20 basis points.
Just going through the bond market on the screen, Tom, we can go through this maturity to maturity. 2s, 3s, 5s, 7s, 10s. We're up 11 basis points on 2s. On 10s, we're up only 6. So the difference between the two narrows, the curve flatter, 25 basis points. The difference between 5s and 10s.
Wow, look at that.
Less than a basis point.
On radio, I really got to state this out for you, the folks, that we've seen curve steepening over the last number of days. John, I have never seen this swing that we see of 12 basis points, 0.12% movement off of the 2-year versus 2 basis points on a longer piece of 3-year bond.
So the Y, Tom, the Y is in the dot plot. We've taken the median dot to 1.9% for 2022. In 23, we've taken it to 2.8%. So this was always a three-part story. 1, you got the Fed decision up 25 basis points. 2, you got the forecasts. Just talking about them now, including the dot plot. 3, you get the emphasis in the news conference. The news conference, Tom, 17 minutes away.
All of a sudden, really interesting to see what's going to happen here. Diane Swank joins to brief now with Grant Thornton, their chief economist. And Diane, one of the arch themes here is a growth slowdown. Do you buy it that we will see solid sub 3% growth?
I buy that we'll see very weak growth. I think it's going to be weaker than that. I think it's fanciful to think that we don't see an increase in the unemployment rate. I do think it's interesting we saw a doubling of the dot plot in terms of 3 to 6 moves. We'd still expect 7 moves this year. That, with the higher energy prices and inflation situation we've got, stalls out the economy and raises the unemployment rate by year end. That's something that the Fed has just not wanted to do, didn't want to go there.
Let's go there, Diane Swank, and I'm thinking of your great work with the National Association for Business Economics. Lawrence Summers made very clear with the Washington Post today that 5% unemployment, to me, that's almost a jump condition. Can we have higher unemployment for the moment and not get into the fear that Mr. Summers wrote about?
Well, I don't think it's quite as extreme as Larry Summers wrote about, but I think part of the issue the Fed is now facing is that we've added fuel to a well-kindled inflation fire with the war in Ukraine. And I think that's very important to understand. And the Fed, even though they said it's uncertainty, right now it's still more inflationary. And the Fed has been behind the curve on inflation. They really thought it would be much more transitory. It's not been transitory, and it looks like it's getting more broad-based. That entrenchment of inflation expectations starting to move up. That is really important because that is what the Fed fears the most. And it's not, I said they were panicking earlier. I think they were panicking earlier. Now they're in full mode of trying to deal with bringing inflation down. But again, it's fanciful to think that you can do that without rate hikes bleeding into unemployment. I think we're going to have to see higher unemployment.
This is the issue. And Dan, you've touched on it, and I want to keep calm about it. Let's go through the forecasts. December projection for growth, 4% for 22. They've cut that to 2.8%. For unemployment, 3.5, 3.5. Hasn't moved. PCE inflation has gone from 2.6% to 4.3. So, Dan, we saw this at the ECB, you raise the inflation forecast, the Fed's done that. You drop the GDP forecast, the Fed's done that. And then I look at unemployment, just going through this now. 2022, 3.5%. 2023, 3.5%. 2024, 3.6%. Can they get rates anywhere near 3% in 2023 without their unemployment forecast changing from 22 to 23? Diane, that doesn't make sense, does it?
It doesn't. And in fact, I mean, the scenarios that I've run, even with oil prices sort of holding 95 for a little bit, 98, that still gets us to a stall out at best in the second half of the year with growth of 1% in the second half of this year. And it could easily get us below that and tip us into a recession. For all intensive purposes, that is a recession in the sense that it allows unemployment to then rise. And in fact, in our scenarios, with the Fed raising rates 7 times this year and 3 times next year, we have the economy slowing where the unemployment rate does continue to rise right into about 8.8%, so not all that far from Larry's forecast by the end of 2023. And I think that's very important to understand is that we are now at a place where the Fed has not engineered soft landings to fight inflation. The Fed is chasing inflation now. That means at best a semi-hard landing where the economy stalls out and you see a slow rising unemployment rate. At worst, an actual hard landing, or you risk something that's much more entrenched and decades long in terms of eroding inflation, our living standards with inflation like we saw in the 70s. Chairman Powell made it very clear in his testimony he did not want the 70s to be the benchmark for which this Fed was judged on. That means they have to worry about the risk of stagflation in this environment, in a global inflation environment that's also got a weak growth environment.
Scott Minerd, you messaged me a number of weeks ago and you said that's what we're going to get, the S word. And I talked about it on air and you heard the pushback live on Bloomberg TV. I remember Bill Dudley joined us on Bloomberg Surveillance a number of weeks ago, and we've talked about this repeatedly this week. He said the Fed forecasts were in fancy land. Are these forecasts, particularly the unemployment rate forecast, that projection, Scott, is that in fancy land?
I think so. Jonathan, I agree with Diane. I can't add these numbers up and make any sense of them. I agree with Diane that if you get an increase in unemployment by 0.4%, traditionally that is a recession. If you look at the fact that if the Fed is to see the economy slow, we're going to see financial assets come under pressure. The only solution the Fed has historically is to dump liquidity into the system, which puts us right back into the stagflation story. So I think this is all fantasy land, and I don't. One thing I think that is interesting here, and I think Diane will agree with me. I'd love to hear it. Is the higher the rate of inflation, the lower real growth is. So if we're marking inflation up from 2.6 to 4.3, by definition, that brings real growth down because the economy, will only grow at a certain nominal rate. But I mean, Diane, I'd love to hear your comment on it.
All right, Diane, since that is the question, what's your take?
Yeah, actually, my forecast is weaker than that for the year, and I have a similar inflation forecast, actually maybe a little higher than the Fed's. But I think that's important is that the numbers don't add up, and this idea that, and they even put it in their statement that they're doing this to prolong the healthy economy. That is true that we need to get rid of inflation, but it's fanciful to think that you can do it without raising the unemployment rate. And however you get there, whether it be growth stall out and you're not growing fast enough to keep unemployment down, or you actually tip into a recession, one way or the other, that's what's got to happen. My fear is at this point in time, given where we are and the risk of stagflation, this is not an insignificant risk. It's something that we're also dealing with abroad. The other issue is that tightrope. The Fed does understand that every rate hike they make, other developing economies have to counter that to defend their own currencies. And they're worried about what are the ripple effects of this globally, and is there a financial crisis beyond our own financial markets that could wash up on our own shore? And I think that's something that they're trying to walk that tightrope. It's a very fine line, but at the end of the day, they're going to have to deal with inflation in the U.S., and that's going to require, unfortunately, I do believe, an increase in the unemployment rate.
Scott, as an investor, what do you do with this?
It's interesting. I think you stay the course in terms of rates at this point. And when I say that, we've already discounted a lot of rate increases, and our work shows that if we get the terminal rate to somewhere in the neighborhood of 2 to 2.25%, that we're talking about a recession. And that's because there's so much leverage in the financial system. When you layer on top of that all these exogenous events around the world, whether it comes out of the emerging markets or what's happening in the Ukraine or the price of oil, you only increase the possibility of that. So, our view is rates are fairly priced here. Corporate credit spreads are actually fairly wide. They could widen more, but again, if you're an investor, you should be looking over a 3 to 5 year horizon. You shouldn't be being a day trader and be thinking about what are we going to go through next month. And so for us, we're basically in the position that we don't see any long-term continued rise in long-term interest rates, and that risk assets like corporate bonds are in pretty good shape. As for stocks, I think this is a crapshoot because on one hand, there are some really phenomenal values out there in tech land where stuff has been crushed. But yet at the same time, the broad indices are not discounting a recession. And I'm with Diane on the fact that whether it's going to be next fall or it's going to be in early 2023, there is a recession looming out there. And, history shows us, though, that when the Fed starts to raise rates, stocks tend to do well. And so the day traders in us should probably think about a rally in the near term, but ultimately the investors should probably think it's a great time to take some risk off the table.
Diane, I'm going to go back to the new thing, the new territory, which is the old thing and the old territory that you and I are weaned on, which is follow nominal GDP. We're trying to do the unthinkable here, to move from, say, 12% top-line GDP down through something Chinese, and I guess we're supposed to get back to the nominal GDP that we used to know and love, call it 4, 5, maybe 5.5%. Do we know the x-axis on that? I don't think we have a clue what the timeline is out one time. My biggest problem with this, Diane, I'm thinking this is like Michigan economics. We don't know the x-axis.
No, and the Fed doesn't know either. They have a high level of uncertainty, and I think one of the issues that we're not sure about, and even as Larry Summers talked about raising rates more, well, I think we don't know how much the balance sheet reductions are going to amplify the effects of rate hikes in the economy and how that ripples through the economy. We've never done this before. This is untested, uncharted waters, and I think that's why you see 6 rate hikes instead of many more rate hikes this year. And I think that's important to remember as well, is how is the balance sheet going to amplify the effects of these rate hikes as they wind that down?
I want to take the economics here. Swan can go over to the markets and the finance of Minard. Scott, if that's the case and the x-axis is a complete mystery, ranges have gone wider because of Ukraine, we get that. How do you trade? What's short term? Is the new long term 5 years?
Well, yeah, Tom, I always make a joke that I think the definition of the long run is we're all dead, but the reality, I say, from an investment standpoint, most people think of 5 years as the long run. And so, I think that the decision you have to make as an investor today is, are you looking at the long run, or are you going to be trying to bet on something which is highly uncertain in the short term? I think the old adage of the trader, Tom, is when you don't know what's going on, get out. And so for investors that are not certain, or they don't want to look at the long run, then it's probably time to move to cash.
There's nothing smooth about this yield curve right now, Lisa. Let me tell you that.
Honestly, I'm looking right now at the 7 and 10-year gap in yields, and it actually is the most inverted in data going back to 2009. To give you a sense, it is inverted, negative 3.4757 percentage points. Just to give you a sense of what that means, basically, or rather 0 basis points, I should say. That means that 7-year yields are that much higher than 10-year yields because of the expectation of a slowdown. 5s,
10s, only a basis point separating them now. Guys, the news conference starts in about 5 minutes. Diane, you're always great at this. If you had a question for Chairman Powell, let's start right there. What would it be?
Well, it really would be, when they talk about ongoing rate hikes, what do they mean? And how does numbers add up with the 3.5% unemployment continuously? I just don't get it. I want to know how, he'll say the dot plot was put in ahead of time, but how is the Fed thinking about this idea that, even in their statement, it's really fanciful that, we can strengthen the economy by doing this. Well, yes, over the long term you can, but in the near term it's a lot of pain, and I don't see escaping the pain. And so I really want to know how these numbers add up.
You're not alone. I think many of us really struggling to reconcile some of these forecasts in this summary of economic projections. Scott Minerd, same question to you. What are you looking for from the chairman?
Well, what I would like to know is, what do they have in the toolkit that in the event that these financial markets become unglued and we start seeing a major slide in risk assets like stocks, that they can do instead of just flooding the system with liquidity? And doesn't that, in his mind, undermine the idea of price stability and then ultimately amplify the volatility in long-term rates?
Scott Minerd, Diane Swong, TK. This news conference 3 minutes away.
And all of a sudden, fascinating, Ian Lingen, who is really, really good, folks, at BMO Capital Markets. John, let me quote completely. This is a credibility-enhancing event for the Fed in terms of inflation fighting, and we expect this will cement the flattening trend for the time being. That's
certainly flatter right now, TK. Let's go through it together. So what have we got? A 25 basis point rate hike, some dissent from the St. Louis Fed President, Jim Bullard, who is looking for a 50 basis point rate hike. Then you move to the forecast. They kick the inflation forecast higher and they cut the GDP outlook. For the unemployment rate, 3.5 for this year, 3.5 for next year. Really? We'll come back to that in a moment. And then, Lisa, to the dot plot. Well, the dot plot, 2022, 1.9%. 2.8% in 23, and that's why we see equities fade on the S&P 500. That is why we see it's really building out the front end of the yield curve through to the belly, out to 5s and 7s, 2s, approaching 2%.
This Federal Reserve is saying that they need to move to a materially restrictive position with respect to policy, that they need to slow this economy by dampening growth. There is little else that they can do. And given that, at this moment, is what's definitely making markets worried, and why you're seeing that flattening just absolutely ripping through the yield curves throughout the maturity space.
How much uncertainty is around those forecasts now?
Honestly,
he sits down in like 2 minutes' time. Can he really cling to those forecasts with conviction, any confidence whatsoever?
How much conviction is there when you don't necessarily have consensus? Does he give a sense of the varied opinions? Does he give a sense of what the parameters will be that could potentially call him in check, John? Honestly, this is going to be a very difficult one for him.
It's different to a hearing, Tom. You know this, we all know this. When you go in front of Congress and there's a hearing, you can talk about your own opinion in speeches. When it comes to things like this, you've got to reflect the consensus. Does one exist, Tom?
No, I don't think it exists. I think, again, this is so important. This is, I really take issue with people that say there's a theory here. You know, it's such a cliche, John, but I'm going to use it on Cliche Wednesday. It is original territory. Intellectually, what Jay Powell and the good PhDs are doing there is absolutely original.
Do you remember Ethan Harris of Bank of America, Lisa, came out a number of weeks ago, in fact, a couple of months ago now, and said 7 hikes for 2022, and he was laughed at.
Yep.
The Fed's there now. Basically, the Fed's there.
The Fed came out with their statement, and I looked at the Fed funds rate and the projection out, and it hasn't budged that much. And nearly 7 rate hikes still priced into the market through the end of this year.
Now, it's one thing forecasting, Git. It's quite another delivering, Git. And you wonder how much pushback we'll get from the market in the coming weeks and months. And you wonder how much that will constrain this Federal Reserve with inflation still pushing 8%. Going into this news conference, markets look like this. We fade on the S&P 500 big time. On the S&P up more than 0.1%. We were up about 1% going into the decision. The NASDAQ up 0.8%. The NASDAQ fades as well. Into the bond market, just ahead of Chairman Powell. Yields on 2s, they are at 197.50. Here is the chairman of the Federal Reserve.
Good afternoon. I want to begin by acknowledging the tremendous hardship the Ukrainian people are suffering as a result of Russia's invasion. The human toll is tragic. The financial and economic implications for the global economy and the U.S. economy are highly uncertain. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we expect to begin reducing the size of our balance sheet at a coming meeting. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024. The labor market has continued to strengthen and is extremely tight. Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year and remaining near that level thereafter. Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy prices are driving up overall inflation. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2%, while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. Our policy has been adapting to the evolving economic environment, and it will continue to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Reducing the size of our balance sheet will also play an important role in firming the stance of monetary policy. At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks of potential further upward pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Let's go to Gina at the New York Times.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder if you could detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
So I guess I would start by saying that, in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong. Conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance sheets are strong. And so all signs are that this is a strong economy, indeed one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Thank you. Let's go to Howard at Reuters.
Hi, Chair Powell. I was wondering, in the SEPs, you have quite a markdown to GDP from 4 to 2.8%. I'm wondering, how much of that do you feel is a result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels. Highly uncertain, but you're looking at higher oil prices, higher commodity prices. It'll be so that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1.75%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
Yeah, so the way we're thinking about this is that every meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Thank you.
Thank you. Let's go to Rachel at the Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with the combination of rates going up, fiscal aid dissipating from the economy, and supply chains getting better. And if you don't start to see that, how will you signal it? What will you be looking for, and what will you be looking for over the course of the year? Thank you.
So I guess I would say that before the invasion of Ukraine by Russia, so let's go back to that. I would have said that the expectation was that inflation would peak sometime in the first quarter, maybe the end of the first quarter of this year, and then maybe stay at that level or a little bit lower, and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices, not natural gas a little bit, but not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around, lots of countries and companies and people not wanting to touch Russian goods. So that's going to be more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, though, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
Let's go to Nick at the Wall Street Journal.
Nick Timmeros of the Wall Street Journal. Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials weren't projecting any interest rate increases this year. And yet, despite the shift over the last 6 months, real rates are as negative today as they were then. So how concerned are you that further inflation surprises will offset the effects of recent policy firming by leading real rates to stay at levels that do not actually provide much restraint to the economy? Thanks.
So that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong. As I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. You couched it in terms of real rates. I would say if you look at the SEP, you've got people getting close to or even above, in many cases, their estimate of the longer run neutral rate. So I understand that doesn't do it for real rates, but if you go out a year or two, many people are in their forecasts are having tight policy from a real interest rate standpoint. So that's something that we're focused on. Of course, it's a highly uncertain environment, and we don't know what's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
Let's go to Victoria at Politico.
Hi, Chair Powell. So looking at the summary of economic projections, you all have inflation coming down over the course of the year to 4.3%. And then you also have rates going up to what appears to still be below roughly what would be estimated to be the neutral rate, although I know that's a little bit uncertain. So I was just wondering, how much of inflation coming down do you see as actually being as a result of the Fed itself raising rates? And then also, if I could just ask, given that Sarah Bloom Raskin withdrew her nomination, what do you expect to do with the regulatory portfolio? Do you expect to assign a governor in charge of that?
Okay. So sorry. Tell me again your first question.
My first question is, how much do you expect inflation to come down as a direct result of the Fed's actions?
Okay, so part of inflation coming down at the very beginning is clearly to do with factors other than our policy, and those would include potentially the supply chains getting a little bit better. Certainly base effects, you're lapping, as you know, when you look at a 12-month trailing window, you're lapping very high inflation in March, April, May, June of last year. So there should be some effects from that as in the 12-month picture. Really what we're looking for, though, is month-by-month inflation coming down. And so it's really, it's all the things we've been talking about, that really haven't helped much, including the shift away from goods and back to services, including supply chains getting better, including labor force participation, all those things that have been sticky and not happening. But a big part of it is the base effects I mentioned as well. I think monetary policy starts to bite on inflation and on growth with a lag, of course, and so you would see that more in 23 and 24. But also remember, we started talking about rate increases last year. For some months now, the financial conditions have already incorporated a significant number of rate increases. So it doesn't start today. In effect, the moves are already priced into the market for a few months now. So the clock is running on that, and I think some of that will be seen in the second half of the year as well. And on the regulatory portfolio, I would just say this: we have an obligation to carry out under the law, in supervision and regulation, and we're doing that. That's what we're doing. The committee is not active, so what's happening is things are coming to the full board, and we're voting on them. We're getting our business done. We got the stress tests done. We've looked at a number of proposals for mergers and things like that. So we're working ahead. Of course, we don't have a vice chair for supervision, as you mentioned, but we're making do with the situation we have, and a good number of things have come straight to the board for approval.
Let's go to Neil Irwin at Axios. Let's go to Neil Irwin.
Hi, Chair Powell. It's Neil Irwin at Axios. Thanks for taking our questions. In the Statement of Economic Projections, we see a forecast of median 1.9% Fed fund rate at the end of the year, 2.8 end of next year. Wondered whether that aligns with your own expectations, in particular on that point of overshooting the long-term neutral rate. And also, if you can tell us anything about how that might be paced, front-loaded, back-loaded, how high is the bar for doing 50 at one meeting?
So I don't, Neil, I've never talked about my own SCP projection. It's in there, but I think Fed chairs have generally not done that because we just haven't done it. It's because we have to put together the consensus on the committee and present that consensus. So I wouldn't talk about my individual one. And in terms of the pacing of it, I would just point out there's 7 remaining meetings this year. This isn't something we discuss or debate or agree on, but there's 7 remaining meetings and there's 7 rate hikes. I would add there's also the shrinkage of the balance sheet, which people do the math different ways, but that might be the equivalent of another rate increase just from the runoff of the balance sheet. So I don't know. We haven't made any decisions on front end loading or going steadily through the year. And as I mentioned, if you look at the SEP, a good number of participants do see more than 7 rate increases this year. And I can't give you, I'm not going to try to give you a really specific test for what it would take to do that, but I will say this, though. We'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going, each meeting is a live meeting, and if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
I think we might have some audio problems with Chairman Powell, as far as I'm aware. Tom, we haven't got that feed right now. It seems to drop out. It looks like the chairman can actually hear some questions that he's been asked, though, at the moment, TK. So unclear what's happening on the Fed side at the moment. Looks like they've got some audio problems on their side, Tom.
Yeah, we'll have to see. We'll monitor that. Neil Irwin there, of course, from the Washington Post and New York Times, over to Axios and Modern Fed Speak, wonderful book on the Fed. John, you know, my basic thoughts here, beside the churn that I'm seeing, is what so many people are writing about, and you nailed this up top of the hour with the release. This was a snooze, but it wasn't. And the wasn't is the dot plots. And I believe I hear Mr. Powell suggesting they're sort of making up the dot plots as they go.
So the team in the control room, Tom, are going to work through this, and when we've established a connection back with the Fed, we'll drop back in. We're back. Let's take a listen.
But CPI inflation was as high as it is was July of 1981, when the effective federal funds rate was 19.2%. But given the current data, how far behind the curve of inflation do you believe the Federal Reserve is in your mind?
So I just would say a couple of things. We have the tools that we need, and we're going to use them. And as you can see, we have a plan over the course of this year to raise interest rates steadily and also to run off the balance sheet. We will take the necessary steps to ensure that high inflation does not become entrenched, while also supporting a strong labor market. And as I mentioned, if we conclude that it would be appropriate to move more quickly, we'll do so. I leave it to others to make the judgment you ask for.
And then just as a follow on that, I wanted to get you on the record on this. What impact has there been on your job, given the fact that you...
Lost you in the middle of the question.
Edward, can you repeat that question?
The impact that, given you're not actually confirmed and Governor Brainerd is not actually confirmed, has there been any impact on your job or the Fed's ability to handle inflation?
None whatsoever.
Okay, let's go to Colby Smith at the FT.
Thank you, Michelle. Chair Powell, how concerned is the committee about the notable pickup in services inflation, which is perhaps less likely to self-correct? And to what extent does it alter both the committee's confidence that long-term inflation expectations will not de-anchor in the coming months, as well as the balance of risks that the Fed may need to raise interest rates further above neutral than indicated in the dot plot? Thank you.
Thank you. So, of course, that's something we're watching report by report, and we noticed it in the last meeting, and it's part of the overall picture. We have expected services inflation to move back up to where it was, and that's part of what's happening. Is in the case of some services, prices are still getting back up to where they were before the crisis. In other cases, it's pretty clear that inflation has spread more broadly across services, and yes, that is concerning. In the meanwhile, we see some progress on the goods side, but really in this latest report, it was confined to vehicles, which is admittedly a large category. So, as I mentioned, the committee acutely feels its obligation to move to make sure that we restore price stability, and is determined to use its tools to do so.
Thank you. Let's go to Steve Leisman at CNBC.
Thank you, Mr. Chairman. I wonder if you could help me understand the kind of logic, if there is one, in the SCP here. As I look at the median forecast, for example, for unemployment, it runs for the 3-year window below the long run rate. I look at inflation being above over the 3-year window, the long run, or call it the neutral rate, so the economy still runs hot. And that is all true in a regime when you run, at least for 2 years, the funds rate above the long run rate. So I guess my question is this: are you not give a forecast here that essentially suggests you will be continuing to run further behind the curve and never really get in front of inflation because the economy will continue to run hot? And kind of on a related issue, you said earlier Inflation will take longer to return to price stability than we had originally expected. Isn't that a choice you're making? And if so, why are you making that choice to let inflation run above price stability longer than you'd like?
Right. So if you look, first of all, there is no, you're looking at medians, but understand that there's no, it's not something we voted on. It's not a plan. But if you look, people do have their by the end of this year, broadly, people are at or close to, or in some cases above, their estimates of longer run neutral interest rate. Okay, so that should stop pushing. That should, in other words, that should be a removal of accommodation for monetary policy, basically. At the same time, we will have done significant balance sheet runoff, and you can think of that as further. In the next year, and just looking at the median, you're now above above the what people estimate to be the longer run median. So and also in many people's forecasts, that actually amounts to tight policy in real rates as well. So why does unemployment remain at 3.5%? I mean, a couple points. One is the connection between in the economy we had before the pandemic, the connection between inflation and the level of the unemployment rate was not very tight. But this is clearly what this is an expectation that really it amounts to the idea that wage increases, which are now running above the level that would be consistent over the long run with 2% inflation, will move back down to levels which are still very attractive, full economy full employment kind of wages, but not to a point where they're pushing up inflation anymore. And as I mentioned, there are a lot of factors causing inflation to come down. And the reality is there are many moving pieces, and we don't know what will actually happen. But no matter what happens, this is a committee that is determined to use its tools to make sure that higher inflation does not become entrenched. And so we are determined on that front, and we'll deal with what comes. This is a modal or most likely expectation, but we'll deal with what comes, whether it's better or worse.
Thank you. Let's go to Chris Rugaber at the AP.
Hi, thank you. Well, let me follow up a bit on that. I mean, there are a lot of economists skeptical that you can reduce inflation as much as you've penciled in without raising the unemployment rate. And I'm wondering just what are the mechanisms you see in reducing demand? I mean, outside housing and autos, how do higher Fed rates reduce consumer demand unless it's through higher unemployment? Thank you.
Well, if you take a look at today's labor market, what you have is 1.7 plus job openings for every unemployed person. So that's a very tight labor market, tight to an unhealthy level, I would say. So, in principle, if let's say that our tools work about as you described, and the idea is we're trying to better align demand and supply. Let's just say in the labor market. So, it would actually, if you were just moving down the number of job openings so that they were more like 1-to-1, you would have less upward pressure on wages. You would have a lot less of a labor shortage, which is going on pretty much across the economy. We're hearing from companies that they can't hire enough people. They're having a hard time hiring. So that's really the thinking there. Is these are fairly well understood channels, interest sensitive, and basically across the economy, we'd like to slow demand so that it's better aligned with supply, give supply at the same time to recover, and get into a better alignment of supply and demand, and that over time should bring inflation down. And I'll say again, though, we don't have a perfect crystal ball about the future, and we're prepared to use our tools as needed to restore price stability. With as I mentioned in my opening remarks, without price stability, you really can't have a sustained period of maximum employment. It's one of our most fundamental obligations is to maintain and restore, in this case, price stability. So we're very committed to that. Of course, the plan is to restore price stability while also sustaining a strong labor market. That is our intention, and we believe we can do that. But we have to restore price stability.
Okay, let's go to Scott Horsley at NPR.
Thanks, and I apologize if this covers some of the same ground you just talked about, Mr. Chairman. I think I missed some of your answer there, but I have a follow-up question on the labor force. We have seen some gains in the prime age workforce in the last few months. I wonder what you anticipate when it comes to some of the older workers as the health outlook has changed. Are we going to see more recent retirees following Tom Brady back in the workforce, and what would that mean for wages and inflation?
It's hard to say. You know, what we saw in the last cycle was that over the course of a long, steady expansion, labor force participation outperformed expectations. And that was just it was a tight labor market, but it was nowhere near as tight as this labor market, but it was a tight labor market. And so people stayed in the labor force longer. It wasn't so much people coming back in the labor force after retirement. That's not something that happens in the aggregate very much. But so that's what was happening. And, you know, more labor force participation is tremendously welcome. And, of course, our policy does not in any way preclude that. This is a situation where wages have moved up at the highest rate in a very long time. And people are able to quit their jobs and move to better paying jobs in the same industry or different industry. So it's a really attractive labor market for people. And once, you know, as we get past COVID, well and truly, it becomes an even more attractive one. So we hope that that will lead to more labor supply. That's a good thing for the country. It's a good thing for people. And it also will, we think, help relieve some of the wage pressures that do put inflation more at risk. That last part we'll have to see whether empirically it works out that way. But you know, in principle, it ought to help with inflation as well. It's not the only thing we're looking for, though, from inflation. We're looking for help from a number of different places, and most importantly, from our own policy.
Okay, let's go to Rich Miller at Bloomberg.
Thank you, Michelle, and thank you, Chair Powell. I'm sorry, I'm having some communication problems, so I've missed some of the stuff you've said, and my apologies if this has been asked. Since the FOMC met last January, financial conditions have tightened markedly. Equity prices down, treasury yields up, bond spreads risen, yield curve has flattened a lot, and even further today, dollar is up. Is that welcome, and would you like to see more in order to achieve your goals? Thank you.
So as you know, policy works through financial conditions. That's how it reaches the real economy, by just the mechanisms you mentioned. And remember that the financial conditions we had for the last couple of years were a function not only of very aggressive and appropriately so fiscal policy, but also highly accommodative monetary policy. The monetary policy settings that we put in place at the worst parts of the pandemic. So it is very appropriate to move away from those. And yes, that will lead to some tightening in financial conditions in the form of higher interest rates and just the sorts of things. We're not targeting any one or more of those things, but financial conditions generally should move to a more normal level so that because we know the economy no longer needs or wants these very highly accommodative this stance, which, you know, and so it's time to move to a more normal setting of financial conditions, and we do that by moving monetary policy itself to more normal levels.
When you say move to a more normal setting for financial conditions, that suggests to me that you want financial conditions to tighten further from where we are now. Am I drawing the right inference from that?
Well, yes. So I would say we look at a broad range of financial conditions, and of course, when we tighten monetary policy, we do expect that they will adjust in sync over time with monetary policy. It's not any particular financial condition, but a broad range of financial conditions. They will reflect, to some extent, they reflect any number of things. But yes, we need our policy to transmit to the real economy, and it does so through financial conditions, which means as we tighten policy or remove accommodation so that it's at least less accommodative, that broader financial conditions will also be less accommodative.
Thank you. Just a little housekeeping note. Those of you in this call may be having some tech issues. If so, I understand the broadcast is coming through clearly on www.federalreserve.gov. So you might go there for the audio. And now we'll go to Jean Young.
Hi, Chair Powell. I wanted to ask about the balance sheet discussion you've had at this meeting. Can you give us any more details? Did you discuss whether to cap runoffs or whether to increase those caps over what period, if there were any details?
Yes, thank you for asking. So at our meeting today and yesterday, we made excellent progress toward agreeing on the parameters of a plan to shrink the balance sheet. And I'd say we're now in a position to finalize and implement that plan so that we're actually beginning runoff at a coming meeting, and that could come as soon as our next meeting in May. That's not a decision that we've made, but I would say that that's how well our discussions went in the last 2 days. So a couple things just to add. We'll be mindful of the broader financial and economic context when we make the decision on timing. And we always want to use our tools to support macroeconomic and financial stability. We want to avoid adding uncertainty to what's a highly uncertain situation already. So all of that will go into the thinking of the timing around this. In terms of I would say this. I don't want to get too much into the details because we're literally just finalizing them. But the framework is going to look very familiar to people who are familiar with the last time we did this, but it'll be faster than the last time, and of course it's much sooner in the cycle than last time. But it will look familiar to you, and I would also say that I'm sure there'll be a more detailed discussion of our in the minutes to our meeting that come out in 3 weeks, where I expect that it will lay out pretty much the parameters of what we're looking at, which I think will look quite familiar.
Thank you. Let's go to Michael McKee at Bloomberg TV.
Mr. Chairman, since September of 2020, you've been operating on a monetary policy framework that let the economy run hot to bring unemployment down. That seems to be over, but I'm wondering how you would describe your reaction function now. What is it that the Fed is trying to do other than bring inflation down? In other words, is it we're going to keep raising rates until it comes down to an acceptable level?
Yeah, so I want to clear one thing up again, and that is that nothing in our new framework or in the changes that we made has caused us to wait longer to raise interest rates. What we said in the framework changes was, and this was really a reflection of what had happened for the preceding couple of decades, actually. What we said was, if we see low unemployment, high employment, but we don't see inflation, then we're not going to raise rates till we actually see inflation. That's what we said, and that was the sense of it. There was no sense in which if we got a burst of really high inflation, we would wait to raise rates. That's simply not in the framework. In fact, quite the contrary. The framework is all about anchoring inflation expectations at 2%. So I do hear this, that the framework, we can't blame the framework. It was a sudden, unexpected burst of inflation, and then it was the reaction to it, and it was what it was. But it was not in any way caused by or related to the framework. So come to today. I think our vision on this on the committee is very, very clear. What we see is a strong labor market. We see a labor market with a lot of momentum, great job creation, and we see the underlying economy strong. Balance sheets are strong. Yes, there are threats to growth from what's going on in Eastern Europe, but nonetheless, in the base case, there's a pretty broad expectation of strong growth. But inflation is far above our target. And, the help we've been expecting and other forecasters have been expecting from supply side improvement, labor force participation, bottlenecks, all those things getting better, it hasn't come. And so we're looking now to using our tools to restore price stability, and we're committed to doing that. And you see that, I think, in the Summary of Economic Projections, and you see that in the decision we make, and you will continue to see it in the decisions we make going forward.
If I could follow up by asking, I guess what you'd call it is the Paul Volcker question. You don't think unemployment is going to rise significantly, but if it does that temper your desire to keep raising rates?
Well, the goal, of course, is to restore price stability while also sustaining a strong labor market. We have a dual mandate and they're sort of equal. But as I said earlier, price stability is an essential goal. In fact, it's a precondition really for achieving the kind of labor market that we want, which is a strong and sustained labor market. We saw the benefits of a long expansion, a sustained labor market. It pulled people back in, and there were really no imbalances in the economy that threatened the long expansion. The pandemic arrived. It was just a completely exogenous event. So that's how we're thinking about it. We of course want to achieve price stability with a strong labor market, but we do understand also that really you can't have maximum employment for any sustained period without price stability. So we need to focus on price stability, in particularly because the labor market is so strong and the economy is so strong. We feel like the economy can handle tighter monetary policy.
Thank you. Let's go to Brian Chung at Yahoo.
Chair Powell, hopefully no tech issues here on this front. Wanted to ask just kind of the broad question about how